I am in such a good mood, Dan Nathan. It is Thursday, April the 6th. That's right? Thursday, April 6th. This is Market Call, 1 p.m. on the East Coast. I'm Guy Adami, Dan Nathan, right across from here. We're in the same studio together. It's the craziest thing. It's IRL here on Market Call. Just a few minutes. EY from SoFi. By the way, her Milwaukee Brewers find themselves at the top of the standings, making short work of the Mets yesterday in a 3-game sweep. Fortunately, the Mets have today's home opener to sort of get that bad taste out of their mouth.
But they don't have.
Why not? What happened? Something happened.
Did they cancel it? Did they cancel it?
For what reasons? I'm just curious.
I mean, it's beautiful out here. It's probably the nicest spring day that we've had.
The Mets would can't. Well, I mean, we're gonna have to look into that, I'm sure, here on Market Call. But EY from SoFi will be joining us. Today's Market Call brought to you by FactSet, Dan, financial data and analytics that are powered by tomorrow, and of course, SoFi, get your money right all in one app. Which is short for application. And a lot of people will be going to their application stores on Saturday, big right before Easter, get those new apps for the spring. A lot going on in the market, although within S&P up a couple handles, you say, no. Actually, once again, below the surface, a lot of things happening, Dan.
Yeah, well,
how
it's
are
funny.
You, by the way? You were at the Ranger game last night.
I was. It was fantastic, actually. We had Steph Mateau. We had Adam Graves. These are two Ranger greats. And then also Jim Leyritz came up.
Yankees.
Yes, how about that?
Hit that big home run in 96 against Mark Wohlers, who hung a slider. And to this day, I'm like, why
was he doing that?
You were blowing him away with gas. Just keep throwing the heat, man.
I know. And he got right back into the game. It was a 3-run dong. A 3-run dong to tie it up in the
changed the whole series.
Yeah, it really did.
Sorry about that. This is not WFAN you're listening to. This is the Market Call.
You would love that, though.
MRKT Call.
People have no idea, and let's see what the people in the comment section are saying.
That's right. I look at comments.
If somebody came to Guy Adami right now and said, "Listen, we're going to give you a seat at WFAN. We're going to give you a mic like this. You have a laptop, and you just talk sports, whatever you want, all day long. You're done. You're like, hey, CNBC." It's been a nice ride.
I always want. It's not a laptop. It's a lap. And I guess the theory is you work with it on your lap.
Yeah.
Does anybody do that?
No.
It should be called like a desktop.
It gets really warm on your lap if you do that.
What does?
Well, your lap. Your lap gets warm if you're working.
Liz,
on your lap.
Hopefully, EY is taking notes. We'll talk about that.
All right, let's get into it because you were confused by the date because tomorrow's Good Friday.
Yes, it is.
And so we have this jobs report, the all-important
tomorrow
jobs report, the March
day when the markets close.
Yes, it is. And so, interestingly enough, again, we've seen a lot of the data weaken. We've been talking about that for a while, and I just want to bring up a Wall Street Journal headline here because every once in a while I'll see something, on the Journal, and it'll just get me all excited. And the headline was "Stocks haven't looked this unattractive since 2007."
Yeah,
and it's really interesting to me. I think a lot of people forget that the stock market topped out in November of 2007. Okay, and 2008 was obviously a very bad year. It was the only year that during the financial crisis the stock market was down. But they're talking about the risk premium, the equity risk premium, the gap between the S&P 500 earnings yield and that of the 10-year Treasury sits at around 1.59 percentage points, a low not seen since 2007. And so when you think about this, so analysts are expecting earnings of S&P 500 companies to edge roughly up 1.6%. So that's come down a lot. We've been quoting S&P expectations via FactSet for 2023 earnings to be up mid to high single digits, and depending upon where consensus has landed. So it's come down. So expectations have come down. The stock market, though, Guy, still up on the year pretty handsomely here. So I guess as we head into earnings season, as we get more data that's weakening, this jobs report tomorrow is going to be really important because jobs has been something that's been sticky despite ISM and some of these other stuff that's coming down. It makes the job of the Fed that much
more difficult. Yeah, and I think and Liz can speak to this when she gets here, but I guess they changed the way these jobs numbers are basically comprised and stuff. So the numbers we've seen are actually worse, which counterintuitively is probably why the market is rallying today. But we'll see tomorrow. Listen, again, we need to see the jobs. We need to see unemployment continuing to tick higher. That's what the Federal Reserve needs. Now, the market will take that as bullish.
Yeah.
But it's anything but. Again, I mean, when you have an economy that's driven by the consumer, rising unemployment by definition is not a good thing. So there's so many counterintuitive things going on here. But here we are. The S&P is 4,100. I mean, it's right there.
Well, here's two counterintuitive things. Let's pull up the S&P 500 chart. You look at the downtrend. We've been drawing it. You see where we just touched. We're well above the 200-day moving average. It's down there at 39.45 or something like that. You see that uptrend there. You and I both think we're going to get a retest of that at some point, probably during earnings season, and then we'll see what happens. But then the counterintuitive nature of this is that even though we're well below the all-time highs at 4,100 in the S&P 500, let's pull up this VIX index. This is the volatility measure of the S&P 500, and it's trading at a level which we've been highlighting, this 18, 19 level. It's been a good time to sell stocks. We've seen lots of sell-offs kind of start with a VIX in the high teens here. And then the last point, and then you've been talking about this for months and months and months, look at the MOVE index. Okay, this is measuring the volatility in the bond market. So I guess my point would be is that if you're seeing all of these measures of volatility other than equities, you know what I mean, are off the charts, whether it be FX, whether it be bonds, whether it be commodities, at some point it's going to come home to roost in the S&P 500.
We've had some comments in the section and we have a great viewership. I see the same names each day, and I appreciate that. But people have pointed out that the MOVE index the ratio of the MOVE index over the VIX is levels we haven't seen.
Jim Bianco from Bianco Research was on Fast Money the other night.
Exactly. And we have people talking about here in our comment section for the last few weeks. No, they are. And my point all along has been for years now, and it's worked a couple times. It's just a matter of time before the volatility we're seeing in the bond market makes its way into the equity market.
Well, you've been saying manifests itself into the.
Yeah, I didn't want to use that same word again. But there was a show on. There was actually a show on like an NBC or something called Manifest, I believe.
Yeah,
and the premise
is about a plane that disappeared, and it was about the man. Yeah,
right.
But it seemed like a Lost.
And then it just
remember Lost. It was on ABC.
Excuse me, Lost.
Yeah, it was a great program.
People were lost on an island.
Yes,
but
on a plane, and there was a manifest.
Yeah. And then people use that word now as like a verb. I'm going to manifest.
Well, I think the best use of manifest is manifest destiny.
Yeah, well, that was created way back when.
I know.
I mean, that's like, but no, the way people use it now, they want to sound smart. I'm going to, I manifested it. It's like, shut the F up. Yeah. I didn't use, I was
first of all, throw some comments in the comment section here.
Please.
Yeah, guy threw an F-bomb out last night.
No, but that was a well-timed F-bomb.
Yeah. But
no?
I mean, well, you're the one who always says, take the emotion out of trading.
Yeah.
Well, that was emotional.
When I say take the emotion out of trading, what I mean is sometimes when you're overly exuberant, and, oh my God, I can't believe I'm long the stock and it's going higher, your instincts vis-a-vis emotion will be like, I got to get out of it. If you take that part of the equation out and say, wait a second, I'm actually right. You'll let it work for you. That's what I mean by taking.
All right. So I wanted to make a point. And this is going to be a little tease because at the end of the program, so stick around. I'm going to give you a trade idea in the Tesla, but I'm going to be doing it through the Tesla Q, which is the inverse Tesla. And I want to talk about emotion about that because on Friday, into the close, remember Tesla was blowing out. It was up 7%.
207, I think.
Into quarter end, and everyone's excited about the deliveries that they were going to report over the weekend, that sort of thing. Well, I got emotional. I doubled up my position and I bought a bunch of the Tesla Q. At $43. You know where I sold it this morning? At $48. Okay. So I'm actually swapping out of the equity or the equity that reflects the bearish nature of Tesla into an options trade. We're going to talk about that at the end. All right. Let's talk about next week.
By the way, yes. You said you got emotional. I would say you got tactical.
Yeah.
You used that strength to your advantage. But I guess it's semantics. I don't want to go
down
down
I know,
this
but
road,
I mean, like, I was pretty emotional. And
you got juiced up.
I clicked off my screen, and I was just hoping that those delivery numbers missed over the weekend. And they did. And the stock was down 10%. So let's talk about this because I really do think in my trade on Tesla is about earnings. Okay. So let's talk about earnings that we're going to see next week because we're going to get started off. Like you and I have been mentioning, some of these industrials, some of these transports, they've been acting very poorly. Okay. The banks have been acting very poorly. They're trying to put a little bit of a bottom in here. The big ones on Friday, we have Wells, Citi, and JP Morgan. So those are the three big money center banks. The next week is going to be Bank of America, I think, in Goldman Sachs. Yeah. So that'll be all Tuesday, really interesting.
Yeah, Monday, Tuesday. Yeah.
Listen, I just want to make one point here, and I've been talking about this for weeks now. I've been trading the XLF. I think I've been trading it pretty decently. Trading it down here. It's found a little bit of a home, and I think it's a really hard press, I think, into earnings next week, right? Because again, I think these companies are going to say as little as they have to about the lack of clarity that they have, right? They're going to speak to a couple different things, but there's no reason for them to kind of lower the boom. You know what I mean? If they're kind of, still worried. Jamie Dimon got a little bit of that out as shareholder letter this year. So again, are they a good press here? No. Okay. So are they discounting some bad news? No doubt about it here. So if the news isn't worse than expected, they're going to rally. And that could be the fantastic setup for a short into Q2.
I would say historically, you're right, given how poorly they've traded. I think there is the but is, wait a second. things have been bad. Things are not going to improve anytime soon. And again, regulation is coming down the pike. And I can't, for the life of me, if any bank CEO gives positive guidance or speaks in like, oh, things look really good in the second half of this year into 2024, that's just foolish to do as a leader because, quite frankly,
who'll do it?
They
Of
don't.
all of them?
Brian Moynihan.
Yeah, Brian Moynihan.
Because frankly, he looks like he played football for 9 years in the NFL. And it's just now
Gerald Ford look to him a little bit.
Remember
that?
I'm sure he's listening right now.
Moynihan.
Yeah.
Yeah.
I'm sure he's a lovely guy. I've
If
never
he's
met
listening
him
right now. They got some bigger problems here.
He's never really impressed. And that's
no,
I'm
dude.
not trying to be
I know a lot. I know
here.
a lot of people in Bank of America, and they are fit to be tied. They are not happy with the upper echelons of that management here. Well, listen, my only point is sometimes you have to divorce yourself from actually the news relative to where the stocks are trading. And so the news could be bad. It could look like the worst headlines that you see if you're like coming new to the story. Let's say you've been focused on the regionals, you've been focused on this other stuff, and you saw that news. Oh, then you'd say to yourself, oh, well, Bank of America is down 20% in the last month or so.
It made a multi-year low over the last couple
So my
weeks.
point is like, if it's not a disaster, you know what I mean? Like the stock could bounce. I just want to wait for that. I will tell you this. I will be long puts into next Friday's. And I talked about the puts that I bought, the 31.5s. Yesterday I was talking about the XLF. I paid 33 cents for those. I averaged into them. I'm down a little below. That's not a great trading strategy with options, especially as they're expiring, but I'm basically risking what I'm willing to lose into that print.
You trade options differently than you trade underlying equities. I agree with that. So I hear you, but I think you also have a strategy, and you also have this tactical, you have a view that tactically you might, in the short term might go against you, but nothing has fundamentally changed. So you might see that relief rally, which will make these things less, the worth will go down, but you still believe that you're right fundamentally. And I happen to agree with you. So we'll see. And for the people out there that, when banks were doing well and said that's a tell on the economy, are the same people now that are discounting banks doing poorly, saying, well, it's bank specific. You can't do it. You just can't play that.
Well, listen, the other thing is, let's just bring up the 10-year U.S. Treasury yield, 3.28%. And what's interesting about this, and I think we made the point yesterday, and we definitely talked about it last night on Fast Money, is like, these long duration tech stocks trading at high valuations, right? Like they absolutely got creamed yesterday as yields were making the 10-year, making new 7-month lows. And to me, that is also counterintuitive. They were supposed to do better. And even into today, like the follow through in like Airbnb and DoorDash. I mean, Airbnb right now is down 4.5%. It was down 4.5% yesterday. So why aren't these stocks acting better? And I actually think you can focus as much as you want on what the banks have to say. I think a lot of smart investors already have a beat on the banks, right? Relative to how they trade next week, it doesn't really matter. The most important thing is going to be tech and what they have to say, the visibility that they have, and the way investors react to that. Because if you pull up the NASDAQ right here, it's at a really important level, right? And so to me, I actually think I think the direction of the market in Q2 has to do with mega cap tech.
I agree with that. No question about it. And Carter's been talking about this. Elizabeth Young, that's EY from SoFi, has discussed it as well. Rates going down in the very short term at the beginning of that move lower was absolutely bullish for tech stocks on the knee-jerk thing. I get it. Until the market starts to come to the realization that, wait a second, things are slowing down. Rates could go lower, yet credit's going to remain tight, if not get tighter.
Yeah.
And that's the lifeblood of these NASDAQ technology names. It's an interesting point that the Josephs, I love this. I guess there are two of them that watch it simultaneously. Jacob, if you want to bring this up, big banks should capitalize on shitty regionals, ? No. That's his term, shitty. By the way, I happen to agree with it. And you know what? There's truth to that, without question. Obviously, too big to fail. I mean, that's what's effectively happening right before our eyes. Deposits will make their way into these big banks. Of course, the problem is that's not the only thing going on here. Banks are going to be strapped by regulation, which is coming, and by the fact that they're going to be more rigorous in terms of their lending. So, again, rates could go lower, but that doesn't mean lending is going to improve. That adds to the NIM. There was a movie like the
Net
something of
margins.
NIM. Remember that movie?
But so I guess the thing, I just hit myself with this freaking mic. No, that was my bad. You had nothing to do with it.
No, I don't know. I mean,
No,
their
but think
arms.
about this.
There's a lot going on in here. Like I'm
I
scared to
know.
move.
We're figuring it out.
Oh, it looks good.
Listen, it's trial and error. We're going to get this thing down. No, I guess my point is like if the economy's slowing, then credit was going to become tighter no matter what. You know what I mean? And I do think it's interesting. I think the spread between what's going on in the 10-year and what a lot of the Fed like speakers are continuing to say about a Fed funds rate. CME Fed funds tracker has got us a 50% chance over 5% after the next meeting. That spread is going to be something that confuses, I think, a lot of businesses
There's a
for a
huge
while.
disconnect.
Yeah.
I mean, the market is saying there are rate cuts coming. The Fed officials are saying, don't be so sure. Loretta Mester, who was out yesterday or 2 days ago, she's not a voting member, just putting that out there.
Yeah.
But she's basically saying, hey, we're staying the course. So they continue the narrative is out there. The rhetoric is out there. They're not backing away from that at all. The market is backing away from it. So we'll see. Is it time to bring in EY from SoFi
I
or
think
no?
so. This is actually one of the I other than our Monday on the tape pod that we start the week off with EY from SoFi with Liz. I think this moment right here, it's about 1:15 on Thursdays, is something that just gets you all excited.
No question about it.
So let's do it.
I know. Well, without further ado, that's a French word, by the way, with a lot of vowels. That's one of those words that has one consonant and a shitload
of vowels. Is that like a good Wordle word?
ADIEU. Could be, but I don't think in Wordle.
Does Liz do the Wordle? Liz, are you doing the Wordle?
She's a Wordle.
You guys have gotten nothing done today.
True. We broke down banks. We
Why
broke
do I
down
look so
interest
tan?
rates, the technicals on the S&P. That's funny. Hello.
Why
Elizabeth.
were you bored? You could always put a comment.
No, I was laughing the whole time. But I want to talk about something, Dan. You call a home run a dong? Because where I come from, it's a dinger.
Don't blame it on me.
Guy Adami's been calling them dongs on the Fast Money for years. You actually say it on air.
I've said it on air.
Yeah.
No, I mean, a big
dinger.
fly. We used to say that cat dialed 9. So nobody, the millennial, you won't understand that because it doesn't make
what do you call? Wait, but Liz calls herself a geriatric millennial. That's what she's.
I am a geriatric millennial.
So dial 9, by the way, Liz or EY from SoFi, by the way, joining us. Thank you. Is in the old days when you had to make a long distance call, you had to dial 9 before the call. So dial 9 long distance. That's where that.
When you were a kid, though, didn't your number have like letters in it too? Because back in the
CR1.
Was it? Really?
I'm not even kidding around.
That's amazing.
CR1. So 271 was CR Croton. 27 for any Croton people out there, you will remember.
None.
And since you went down this path, I apologize, Elizabeth. My town, Croton on the Hudson, you can go to your Google machine and check it out. We were the last town in the country that only had to dial 4 numbers to make a call. For example, if I were to call my grandmother who lived down the street, right, on Cedar Lane, I would just dial 9069.
Just that's guy's ATM pin.
No, it's not.
Yes.
See, that's why I knew it's not. But anyway, and then we had to dial 7 numbers. So then we had to dial 271, and people were apoplectic about that in Croton, you can imagine. But we went to 10. Holy shit. I mean, that's like that World War III with Brad Pitt, like people jumping over walls and shit. It was out. It was out of control.
World War Z. Did you like that, Liz? World War Z?
You think I saw something called World War Z?
Oh my goodness! Sorry. I will tell you. I will tell you this. It was probably March 15th of 2020. Okay, we're all
the Ides of March.
I remember World War Z was trending on Netflix, and Hulu, on everything, and I watched that movie again. And and it's also interesting that there's all this post-apocalyptic stuff after the pandemic, like The Last of Us. Have you seen some of this stuff? Station 11. These are some great programs here. But
people, I'm reading the comments. People are saying,
we have no control over this. This show is going to go until like 2:30.
You heard us talking about the banks, earnings, market 4,100. The risk. I mean, if you look at where we are in terms of stocks through one metric, the worst we've been since 2007. Not according to us, according to the Wall Street Journal. What are your thoughts on those things?
Yeah, I mean, I'm tempted to come on and be positive because we've been so negative, but turns out the data still says we should be negative. And a couple things. Sorry, I'm going to go back off the rails for just a second because there was a question in the comments that I have to answer. It said, what's the guy's name who slides down the slide every time there's a home run at the Brewer Stadium? His name is Bernie.
Bernie.
His name is Bernie Brewer. Yeah. And there's fireworks that go off and then he comes down a slide. Anyway, so it's still not good. And the thing about today, even, we opened lower, we stayed lower for a while. We had, as you mentioned, Guy, revisions to the initial claims report, which were not good, right? It actually made it sound like the narrative we've been hearing for the last 12 months is not true. And the market is still here going higher. So look, comments from Bullard apparently earlier today that said, rates have come down. That's going to help. Conditions have tightened. Guys, Bullard doesn't vote until 2025. So he can talk all he wants, but he's not a voter. So we got to like suss out some of this noise. But here's the other thing. Maybe this is a little bit of like a pre-rally into earnings. We're hoping that earnings season is going to be better. We all know hope is not something that you invest on, but I think that next week is when we're really going to see some serious volatility. We're going to start seeing serious volatility in the market because earnings have not come down. I tweeted this earlier. Earnings estimates have barely budged, even after the banking crisis was announced. So something's got to give, something's going on. And that equity risk premium, I know it's kind of an academic term that people like us talk about, but it matters because you got to think about it this way. How much are you getting compensated for the risk that you're taking? The higher these stocks go, if we're headed into a recession, the higher everything goes on the risk side, the further and faster it can fall if and when we have to price that in. So the equity risk premium really, really matters here.
Yeah, and I guess it also comes down, Liz, I think, to breadth in a way, because at this point right now, when you look at all the underperformance we're seeing, obviously in financials, you're seeing it in industrials, you're seeing it, in a whole host of other economically sensitive sectors. We've talked about small caps, how they've underperformed of late. It really is this concentration in about 10 or 20 stocks, right, that are like historically to themselves and to the broad market and the averages over the last average multiples over the last 5-10 years. They're really expensive. So all of a sudden now that whole risk premium, it becomes really important because such a small amount of stocks are controlling, really, I think the fate of the market, which makes me a bit nervous. All right, Liz, talk to us a little bit because, again, I think our loyal viewers here on Market Call, they know what you're doing. They know when you are writing your weekly note for SoFi, there is multiple goals. I mean, the first goal is to service your members, as you call them over there at SoFi.
I'm not sure about
right?
that.
The second goal is to see how tweaked you can get Guy Adami.
That's 1A and 1. It's like the Mets have Verlander and Scherzer, so you have a 1A, you have a 1 and a 1A starter. That's the same thing with. And by the way, so as we get into it, we can throw the note up or pieces of it. You've actually gone down the John Bon Jovi route. Now I will tell you,
that's right.
My Spotify playlist now currently has 835 songs. There's not one Bon Jovi song on that list. Back to you.
It's a real shame. It's a real shame. Let me tell you why I like John Bon Jovi. Back in 1994, he released an album called Crossroad. I was 12 and I was just getting into rock and roll. I was just getting into, I don't know, whatever, music that I liked that my parents didn't force me to listen to. There's a song on it called Always, and I fell in love with the drums on it. I also learned from this song Always that there was a difference between the album version and the radio edit, because the album version of Always has a little bridge right after the first chorus, which is a rare place to put a bridge, but it's still there. I love it. The radio edit kind of stunk. Anyway, that was my John Bon Jovi.
Speaks your language from baseball to hair metal.
She should meet our friend John Alasia, if you think about it. I think she would love JJ.
Yeah.
I mean, you love him. I love him. He might be listening now. Anyway, please. Alasia. That's a well done by you. I mean, that's what radio back then did. They didn't think people had the attention span for longer songs, so they would butcher the shit out of them. The Doors famously had their songs reduced. Obviously, Leonard Skinner's Freebird, for example, reduced. The only song that I don't think they butchered would, of course, be the great Stairway to Heaven, which is 8 minutes of exactly that.
Is it weird that I can just finish their thoughts
well,
like that? I knew where you were going. That in the movie Almost Famous, there is a scene that they cut out. It's on the cutting room floor, and they had a scene where they took the mom, and then and the boy who's ever the main character, right? And they took the boyfriend of the girl, and she went away, and they played the entire Stairway to Heaven for her. And there's like doing air drums and everything like that, and it's an amazing scene. Cameron Crowe wanted to keep that in there. They're like, listen, we can't keep a 7-minute cut of Stairway to Heaven. All right, we are off the rails. I hope you guys don't mind it so much. It's been a long week for us, hasn't it been a long week?
My God.
It's been a long 2 weeks. Last week was like the longest week ever.
Yeah, it has been. But Liz, talk to us, run us through. And one of the things I really like about your note, and I mean this, is that you focus on a couple of things each week that you think were important to you, and that you think is going to be something that your investors, your members should be focused on the next week. You're not going all over the place. This is not like a 2,000 word opus or anything like that. You're really kind of getting to the important part, which is also the name of your podcast. Look at that. Go follow it in the podcast stores. It's the important part with Liz Young here. All right, Liz, talk us through your note here.
Yeah. So obviously Q1 earnings season kicks off next week. I used Living on a Prayer because honestly, the lyrics just worked really well with it. We've been hearing for a long time. If you look at that first chart, this is easy to explain. The blue is where margins were expanding. The red is where margins are contracting. So that big, most recent blue triangle that you see is what drove the narrative about earnings are going to be fine. They don't need to come down anymore because margins are so fat. Everything's going to be okay. Companies can absorb it. They're passing it through, blah, 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 blah. Well, then we crossed over and you can see that the contraction is just beginning. So we put the longer term chart in here because I wanted to show people that the contraction doesn't usually end where we are right now. And you typically see a peak in earnings and then a contraction, which is the next chart, a contraction of roughly 23% in a recessionary environment. So keep in mind, the peak just happened in the third quarter of last year. And we're using trailing earnings for this because it's the actually reported what happened stuff. If that decline, that average decline actually occurred, we got to go down to $167 a share. Now, I don't think we have to get there. And I wanted people to sort of see all of this over a longer term perspective to put it into that context. I don't think we have to get all the way down to $167 a share, but we probably got to get down below 218 because of everything that we're facing in this environment and because of the fact that estimates bottom up and top down, like I said before, have not budged even with everything that happened in March. So I think this earnings season is going to be more interesting maybe on the revision side. I don't know what's going to happen with the actual reports. I think we're all expecting financials to not report well. But on the revision side, I think we're going to see a lot of activity this season, and that's going to change the way that we're looking at the market for the next 9 months.
All right. So I love this because it illustrates, you could visually see, and this goes back to 1985, but let's go back to that prior slide real quick, if we may. Now, if you think about that, margin expansion happened starting, I would imagine, mid-21 into 2022. You know what else is you're having in the midst of this is huge multiple expansion because, margins can increase, but the subsequent or the commensurate earnings were not increasing. Now go to the next slide, please, if we can. We're halfway there. Well, we're actually just starting. It's more of a Carpenter song. We've only just begun, but that'll be for next week. But even if you don't think it gets down to 167, which is the historical norm in terms of percentage drops, let's just say it's in half. Let's say we get halfway there. We're still talking about, if I can do the back of the envelope, $195 or thereabouts, which is significantly lower, obviously, than we are now. And again, what's the right multiple for that? I'll even give you a 17 multiple. I will put a 17 market multiple on that 195, and we're still sub 3,400. So no matter how you dice this up, EY, the market is rich here. Back to you.
Yep. So the halfway there is actually about the fact that we've had 1 quarter of negative earnings growth. So we're halfway to an earnings recession. This quarter is also expected to be negative. If we clock in at a negative growth rate for the first quarter, that will be all the way to an earnings recession. Also note that second quarter is expected to be negative. So the contraction doesn't stop after 2 consecutive quarters. So that's what we're halfway to. And that goes into, I know I've talked about this formula before on this show, the formula for an actual economic contraction. You've got the market goes first. It has to be some sort of bear market. Usually if it's a recession beyond 30% peak to trough, then you've got an earnings recession. Then you've got an economic recession, meaning that's how it's confirmed. That's usually the order it goes in. So this is why I think next week could be the beginning of some volatility in the market, because we are right on the cusp of confirming an earnings recession. And if that's the second thing that happens, the market likely cracks first. And then after that, you confirm the economic recession, which is done with things like the jobs market, unemployment, PMI, GDP, all those things. But that, as we know, takes a longer time to come out in the data.
Yeah. And I guess kind of revisiting what we talked about at the start of the show. I mean, this is why the banks and what they have to say, the sort of visibility that they have and the kind of perception about like what their lending is going to be like over the balance of this year, especially given the lack of clarity that we have on the strength of the economy and the notion that at least the bond market's telling us that a recession is very likely. I mean, that is really going to set the stage for Q2 earnings guidance here. And let's do this here, because this is obviously one of my favorite times of the week on Market Call. This is when we preview John Butters. He's the senior earnings insight analyst over there at FactSet. He has a report out every Friday called the Earnings Insight Blog, and we get a preview of that on Thursdays. And so what John is tracking already is the S&P 500. This is the negative guidance that has been given. 78 of the S&P 500 companies have issued negative EPS guidance for Q1 2023. To date, the number is above the 5-year average of 57 and above the 10-year average of 65. What's important about that is that we are literally only 15, 17% through S&P 500 earnings for Q1 here. This number is also the highest number since Q3 2019 and the fourth highest number since FactSet began tracking guidance in 06. Information tech 27, industrial 16. All right, what's interesting about this data to me, Guy, okay, is that the number is the highest since Q3 of 2019. You know what happened in Q3 of 2019?
Yeah, well, I will tell you. I mean, there was a blow up in the overnight repo market that nobody wants to talk about.
You've been talking about that a lot, but we also had the last time the 210 spread inverted. And, at the time, I remember all of us talking about the track record of that inversion and what it meant for the likely oncoming recession. Now, we did have a recession in 2020. It was not for the reasons
unrelated.
Yeah. But it's interesting, Liz, when you think about that, it was likely coming. Okay. You know what I mean? And so that also takes us back to 2018 when we had the Fed raising interest rates. But then we had the stock market sell off. How much, Guy, in Q4 of
19.9% from Halloween of that year until Christmas Eve.
And at the time, that was based on a growth scare, both here and abroad. So there was a recession coming. So I do think that John Butters tracking this kind of negative EPS guidance for Q1 is really important. I think it's interesting also that we've had a high instance of negative guidance among tech, because we just said this. This is where we think the rubber is going to hit the road when it comes to tech here. Thoughts on that, Guy? And then Liz, put a bow on this little thing for us.
Well, the mother's milk, as Larry Kudlow used to say, of the market or earnings.
You really just did that to me. You quoted Kudlow on our program.
Mother's milk.
Of all the people.
Earnings growth, revenue, and revenue growth. And unless you have at least three of those things, you really don't have. You have a market that's built in sand, and I believe that's what we have.
Yeah.
You don't have the commensurate growth, and people say we're not cherry picking. I mean, that's what's out there now. The market chooses to go higher in the midst of in spite of all these things. I mean, as Dan would say, have at it. You see weird things in the long weekends. I get it. But Liz's earlier point is spot on. Volatility next week coming to a theater near you, to me, makes a lot of sense. And by the way, I saw a lot of people did this. If on 3 in the comments section, we could all just type, what is on 3. Ready, people? 1, 2, 3. Butters, because we have to do justice. And I love when people the comments will just, there they come. I'm seeing Butters. Just keep going.
All right, Liz, give it to us on the negative guidance here. Yeah.
Wait, but I want to talk about something real quick first, because you mentioned the yield curve inversion in 2019 and then the bear market in 2018 of not quite 20%. Everybody think about this, okay? That, by the way, Guy, you were right. It was 19.86%, rounded to 19.9%. That, not quite a bear market. That was no mistake. And then the yield curve inversion that happened was like by a whisker for a hot minute. Okay. Yeah. So both of those things together, even though they occurred separately, but both of those things together still kind of questionable as signals. All right. That would be a time where I think you could say we might manufacture a soft landing, because those signals aren't clear. The signals we have now, yield curve had inverted by 110 basis points. We've got a near-term forward spread inverted by 150. Go on down the line with the inversions, and a bear market in both the NASDAQ and the S&P confirmed. The bear market started. I think both of those signals are pretty clear. undeniable. And anybody who's still calling for soft or no landing, I don't know what they're looking at. So you have to really be careful with what's in your portfolio, what you're chasing, and what your expectations for earnings are. To my points earlier and to those charts earlier, we are just at the beginning of seeing margin compression and just at the beginning of that turn from the peak back down. So be careful about your timing here, because there are two things that go up in a crash: correlation and volatility. Okay, volatility goes up, correlation goes up, which means everything falls at the same time, and you cannot catch it. It happens fast. So you have to be ready before it starts.
Yeah, and that's a great point. Just if you think about, again, some of the underlying weakness that we've mentioned in small caps and some other parts of the market here, it's really being held up by, 10, 15 names, maybe 20 or something like that. And to your point about correlations, if there are any big tech disappointments on forward guidance, I mean, correlation is going to go to 1, and that's how we probably get the S&P down in the year. All right, Liz Young, EY from SoFi, thank you so much for joining us. Obviously, guys, where to follow
an update, by the way.
You know what? An update on what?
Uh-oh.
I've made some inroads into the Milwaukee Brewers organization.
Oh no!
I mean, do I have a choice in this? What if I don't want to throw out the first pitch?
No,
you can do it. You can do it.
Can I tell you something? I know we got it. Dan has a trade coming up, so don't leave yet. Your parents would be your father would be over the moon watching you walk out to the mound and a beautiful Saturday afternoon with your Brewers jersey on, probably like a Robin Yount or Paul Molitor jersey. He'd be so happy. That would make his year. So
he'd stand in the on deck circle and clap and tell me and yell to me encouraging things, but also probably criticize my throw afterwards, the accuracy of it.
Yeah. Wouldn't that be amazing?
Can I tell you something? And some of the people, hopefully in the comment section, will enjoy this. I think, wouldn't it be amazing if we had Guy who sang the national anthem, and then he was also the umpire, and then somebody yells, "Hey, look, it's Enrico Palazzo." You know what movie that's from?
Yes, it's those dumb movies.
Naked Gun. All right, Liz, we got to say goodbye. We're running late. Thanks so much. You rock. See you next week. All right, let's do this thing.
I dig EY from
She's the best. You know that. She's got a great sense of humor, and her ability to talk markets, sports, and music is pretty darn good.
She brings it. She's smart as shit. Yeah. Anyway, back to you, Dan.
Okay. All right. Let's do this thing. So, all right. So let's talk Tesla here. And as I just mentioned, you guys know how I feel in this name. I do think it's an unusually good setup for a short here. Maybe it bounces a little bit into next week. It sold off about 10%, since last Friday here. That's a big move in a short period of time. But I just want to look at this chart. Okay, guy, when you look at that $200 resistance level, it never got to its 200-day moving average. It today broke that uptrend that had been in place from the January lows here. So when I look at this chart, I say to myself, okay, it's going to have to retake in a meaningful manner, okay, that uptrend, or that past support becomes resistance. Okay, that's the start of this thing. They report on April 19th after the market closed. The implied move in the options market is about 7.5% in either direction. Now, that's not particularly useful on April 6th here. We have 13 days, but it's just kind of giving you a sense of what options market makers are pricing right here for the one-day move. So I don't like the technical setup. Fundamentals here. Okay, they just missed the delivery estimate, their own estimate, the consensus. We know that there's been numbers of price cuts here. We know that margins are going to be under pressure. I think there's a really good chance that what they basically guide to is not going to be particularly great. So we also have that. All right, so I bought and I got emotional. Okay, I kind of bought the TSLQ. I doubled my position Friday afternoon into the close there. I had a good trade this week. I took a bunch of the TSLQ, the ETF. That's the inverse of the Tesla stock. Okay,
as Tesla goes lower, TSLQ goes higher.
Correct. That's exactly what happened here. Yeah. So you look at that chart here, and if I just like looking at that chart. This ETF was introduced when it was about $50, okay, last summer here. And I look at this thing, and that looks like a great double bottom, and I want to play for a move back above 50. So how am I going to do that between now and April expiration, catching the earnings announcement? I want to use a call spread. I want to define my risk here. So today, when the ETF TSLQ was trading 47.40, I could buy the April 50.55 call spread, paying about $1 for that. It's actually cheaper than that right now. It's probably like 90 cents or so. Buying to open one of the April 50 calls for $1.50, selling to open one of the April 55 calls at about 50 cents. Again, that $1 is the max I can lose here. Profits up to $4 between 51 and 55, and the max gain of 4 above 55. Losses up to 1 between 50 and 51, with a max loss of 1 below 50. Here's the risk reward. This is what I really like about this trade. I'm risking a little more than 2% of the ETF price here. I have a break even up about 7%. I have a max potential gain of a little more than 8% if the ETF is up 14% in 2 weeks. Again, catching the earnings, I'll look to cut my losses if this thing is worth about 50 cents or less. We don't like to see long premium directional trades go to zero. And how do you do that? You have a mental stop, you cut your losses. And so I just want to make a point here. So let's just say you traded a 10 lot, okay, of this $5 wide call spread. You paid 1 for it. You'll be risking $1,000 to make up to $4,000 if it's 55 or higher. I just really like the risk reward. Now, you may say 14%, max gain potential here. That's a lot. Well, I'd tell you that the 1-day implied move for earnings is about 7.5%. So I like the risk reward here. I've swapped out of the ETF, so I don't have that risk, and I'm defining my risk. Guy, what do you think?
So here you go. So I look at this and you put the numbers out and they're all correct. Here's how my mind looks at it. This is basically risk 1 to make 4. But since you brought up the fact that you'd probably be stopping out at 50 cents, you're actually 8 to 1. So you're risking effectively 1 to make 8 if you really come down to brass tacks and allow that stop to kick in. The risk reward sets up well. Your timing is right in terms of earnings. I think you're getting paid enough to sell that $55 call. That 50 cents is getting, you're getting basically rewarded enough to make that sell. If it was less than 25 cents, I'd say there's no reason to do it. So this makes a lot of sense to me. And listen, if you think about it, we thought Tesla could get down to 165 recently.
Yeah, pull that chart up.
163.96.
Pull up the Tesla chart. You made a great call on that.
It bounced, but then there's the chart. The subsequent bounce, though, did not get us back to levels we saw earlier this year.
Yeah.
We stopped short of that.
So lower highs is what you're
lower
saying.
highs.
Yeah.
Now we're through that uptrend line. So 165 seems to be in play, which probably gets you through. I mean, it probably gets you right to that 50.
Guy,
I can't do the math,
you see
but
the
it probably
gap?
gets you.
No, look at that gap at 150. That was earnings. That was earnings. Okay. So again,
exactly
I just want to make one really important point here about this. So when the stock was like 140 into earnings last quarter, it had sold off, okay, down to $100. Okay, just to be really clear, okay, this stock was 700 and sold off to $100. Okay, they could have said anything and the stock was likely to rally. The fact that it's now making lower highs, I think, is important. And the other point, so I think if they disappoint, it's going to round trip to 150. And so you may ask yourself, why are you then capping your gains in a call spread? Okay, I will work into this position, okay? And there will be some that will be outright long that won't be capped. And I'm probably a little early here. Let's see if this can get above that uptrend. And if it does, I'd love for that and then for it to fail. So again, you don't want to be setting up for an earnings trade too early. You know what I mean? You may find yourself the day before earnings willing to take the same amount of risk, okay? But then because you're already in the position, you might have the wrong strikes as it trades, as it gets into options. So this is something I'm doing small right here. And most importantly, I swapped out of the TSLQ and now I have this exposure, but I'm giving myself some optionality to play this into the print.
Let's just look at a longer term chart, because I think you said 700. I think the all-time high risk split adjusted is north of 400 or so.
Did I? Yeah.
But let's just, if we could pull up a chart.
Oh, it was 400. You're right.
Just
Sorry
to
about
see.
that.
No, that's fine.
400 to 100 is what happened.
But with that said, you're still talking about, listen, despite the fact the stock has rallied off 100%, it's still down over 50% at these levels from its all-time high. And at a certain point, it was down 75%. So although this bounce looks significant, which it is, the stock's still been in a pretty significant downtrend now for quite some time.
And I just want to make the point. I think all of you people, you know how I feel about the company. You know how I feel about their guidance and the way they give it. You know how I feel about the competition. You know how I feel about the concentration risk that they have in China here. So like, to me, I don't know what chart that is, but give us a 5-year, guys. Just hit the 5-year thing down there. And so like, I just think that this is the quarter where the rubber is going to hit the road here. And I also want to make a really important point. This stock, whether you like the fact that it's up 100% from those January lows, from a technical basis, it's broken. Okay. And when you have a broken chart, guy, like a lot of funky stuff can happen here. So to me, I would not be surprised if we go back and fill in that gap towards 150. The next stop is 100 to the downside here. And especially if we go into a recession here and abroad, and then you have these competition issues in places like China, and then you have some sort of geopolitical dust up in China, there's no reason why this stock should not go back and retest those levels. And again, this is not me being a perma bear on the name. It just seems like low-hanging fruit as far as if you're in the geopolitical messy camp and the recession camp for the balance of this year.
We got off the rails early.
Sorry
That's
about
my
that.
no, it's my fault. I apologize.
Both.
We got back on the rails.
Yeah, we did.
I think we brought the goods, which is our want to do each day.
Yeah.
This has been Market Call.
Yeah.
I want to thank EY from SoFi for joining us, bringing that shit.
Yeah, and just it's a pretty holy week. My people have the Passover.
Pesach.
Your people have Good Friday tomorrow,
Holy Thursday,
and then the
Friday,
Easter, right?
Sure.
So to all of you
Easter
guys
Sunday.
who observe all of this stuff, enjoy, be with your families.
And if you're out there at Shea now, I hope probably a couple innings in. Hope the Mets are doing well in their home opener. Much ballyhooed anticipated home opener. A lot happens, a lot of pomp and circumstances. The Mets put up all their World Series championship banners, which takes about all of 3 minutes to do.
Yeah.
Of course, they'll
86?
probably 69.
69.
They lost in 73.
Yeah, they did.
Then they won in 86. They haven't won since.
They lost to the Yankees in 2000.
They did.
Yeah. Did they get swept?
No, it was 4-1.
They swept the Padres the year before.
The
Is that
Yankees
right?
did. That's correct.
That is
Tino Martinez hit a grand slam after being struck out and a pitch that was not called.
Yeah.
Next pitch, he took yard.
I love Tino.
The Mets will put up their wild card participant banners, which is complete horse shit. It's really lame. And Mr. and Mrs. Met will be there in the Apple, and Amanda's like, please stop, guy. And I'm going to stop.
Right here.
Thank you, EY from SoFi. Thanks, Dan Nathan.
Yeah.
Thanks, Rafus and Jacob and Amanda. Just getting it
Yeah,
done.
They're fine.
Butter's killing it. I mean, people
Butter's
on the
the
comments
man.
just saying Butter's left and right. He's a folk hero.
He is.
I want to thank SoFi, Dan. Get your money right all in one app. I
Yeah.
want to thank FactSet, Financial Data and Analytics, powered by Tomorrow. They're also our data provider. I want you to smash the shit out of the like button, and I want you to subscribe to our YouTube channel, which is growing each and every day. We won't be back tomorrow unless something happens, but it's a market holiday. So what's going to happen?
Nothing.
I don't know.
Yeah.
But we will be back on Monday. Folks, see you later.
See you later. Thanks.